Last year, the ASX 200 climbed about 7.5% thanks to a strong performance from the banking sector. This year, interest rates in Australia are expected to fall, which means less returns for the banks and potentially a weaker performance overall. I caught up with Milne from Wilson Asset Management a little earlier to understand what's in store for 2025.
The market has been quite weak over December and January. We often talk to a Santa rally, and the Santa rally came early in November and then died. And the weakness in the Australian market has really been in sympathy of the US. The US market has been hit on rate cuts coming out of the curve, so financial conditions are now tighter than they were a few months ago, and that has really hurt equity market valuations, and the ASX has reacted on the back of that too. Another reason for the move has really been the Australian dollar. It has been crunched over the last 6 weeks, trading at 61 cents, and there are a few reasons for that. So firstly, the AUD is a risk currency, so when markets are down, generally the ASX is lower as well. And we are expecting interest rate cuts sooner, while the US is expecting less of them. So when you combine those two measures, that has put a lot of pressure on the Australian dollar as well.
Yeah, the market seems to have come off a bit over the past couple of months, but what are you expecting in the months ahead for the ASX?
When we look at what has come off within the Australian market, it really is what makes sense given the macroeconomic environment. So we have seen strength in those defensive names such as healthcare and insurance, and weakness in the likes of tech, consumer discretionary, building materials and the like. Looking ahead, we expect a year of, I would say, moderation. Moderate equity market returns, nothing extraordinary, moderate economic growth. We're entering a cutting cycle, which will help the consumers, but that will take time. So we expect relatively normal equity market returns and maybe hopefully some reversion between sector performances too.
Yeah, well, one big X factor is Donald Trump taking over as President of the United States very soon. One big thing he's talked about has been tariffs, potentially on global goods. I mean, what sort of a risk is that for Australia and for some big businesses that trade here?
The Trump tariffs certainly are a risk, but I would say they are a known risk. What is actually an unknown risk is the retaliation from the countries that are experiencing these tariffs back onto the US and other countries too. So we see those risks as not priced, and we expect it could be a relatively turbulent few months for global markets as a result of that once Trump is in power. The other major factor we are watching is China. So China is clearly a target for these tariffs, but they have stimulus up their sleeves as well. We don't expect they will announce the stimulus or act upon it until they know what they are facing from a tariff headwind perspective, but it could be an opportunity for the miners at some point this year.
Yeah, the last couple of months of 2024, China kept saying it was going to potentially provide stimulus to its economy and never really did enough to really get investors excited. So you think the Chinese government's basically just waiting now, wait and see what happens with Trump, what happens with tariffs before potentially providing some more stimulus to its economy, which we know has struggled quite a bit over the past couple of years.
That is exactly right. Chinese policy officials are well aware of the economic challenges that face China, and they are wanting to do something about it. But why would you fire all your bullets when really you don't know what is coming? So I think they're waiting for certainty around the headwinds that they are facing before telling us everything that they have planned.
All right, and looking at the WAM Leaders Fund, what are some of the asset classes that you're liking right now? I know you mentioned insurance earlier. You do have ownership of some of the big insurers in Australia. Outlook for them must be reasonably good this year, right?
The outlook for the insurers is very strong. Not only have they had very limited catastrophes this year, weather has been very good across Australia and New Zealand in particular, so impacting IAG and Suncorp. But premium rates have continued and claims inflation is coming off. The rate environment is also very supportive for them too. So it feels like everything still is going really well for the insurers. Some other sectors we like are the REITs names. So a few particular names within REITs include Dexus, which has sold off considerably, as well as Mirvac. We believe they're trading below their asset values and have a good year ahead of both of them. We also do like some Chinese-facing consumer names such as Treasury Wine and A2 Milk as a more medium-term play later this year.
Yeah, and just on the insurers, obviously there's some big wildfires happening right now in LA, and I know QBE, I believe, is part of your portfolio, and they're more of a global-focused insurer. Do you think there's any risks there in regards to QBE and escalating payouts as a result of what's happening in Los Angeles?
The direct risk for QBE from the LA wildfires is very limited. They have said they have market share of less than 1%, and it is an area that they have been shrinking in over the last few years. More importantly, what this really raises is that the reinsurance cycle looked like it was softening quite significantly, and this really pushes out that softening. It's just another example of the impact of climate over the long term for the insurers and the reinsurers, and why prices will probably continue to keep going higher.
Last year, it was really all about the banking sector that helped drive those ASX 200 returns, and CBA was one of the massive winners. Do you think this year is going to be as good for the banks as last year?
Last year, the banks had an incredible run, and there were a couple of reasons for that, but the main one was money flow. Money was flowing out of China, and it was finding a home in APAC. It didn't want to move into the miners because of their Chinese exposure, and so a lot of that money flew into the banks. What we'll really need to see is either the miners regaining their strength or a move out of the ASX entirely to see the reversion of those bank valuations. For us, we do not see value in the banks' names at the moment. Commonwealth Bank is a fantastic franchise, but it should not be trading on 3.5 times book when it is writing loans below cost of capital. So we don't see any logical reason to allocate capital to the banks at this stage.
Anna Milne from Wilson Asset Management, thanks for coming on the show.
Thanks for having me.